Welcome to our weekly investment update. My name is Chris Marshall. I'm Head of Investment Strategy at Dragon Investment Managers, but I also sit on the 75.3 Investment Committee. So as we do in these weekly investment updates, it's nice just to look back over the past few trading sessions and really pull out some of the large data sets or headlines which have moved markets and have really been coming out in the world of economic data land. So as we look to markets, of course, we've seen most of the major indices trade with a lot less volatility and a lot less momentum in the last few trading sessions. Most of the major equity markets are slightly up as we come into the Thursday's trading session. And as we turn our attention to what's been going underneath in the economic landscape, in the real economy, I think one of the big headlines that most people will have seen is this print number of American job losses. Expected to be in the 20 million mark. We saw a report out on Wednesday, 20.2 million. This is from one of the payroll processing companies, but it's really that kind of the Friday's labour report, which is the official statistic. But we do have a good idea from that early report on Wednesday. Now, to put this number in perspective, 20 million job losses in a single month, we actually have to go back to September 1945 in the US to find the next historic high. That was only 2 million, and of course this was coming off the back of demobilisation after the Second World War. If we look to Europe, we actually see a very similar story in data. Of course, it shows up in a different category. We've seen very different policy measures from Europe to US. US is much more about upping unemployment benefits. Europe has been about keeping workers on the books generally and supporting payroll through various programs. So within Europe, we've actually seen furloughs rather than job cuts. We're now seeing about 40 million workers across Europe furloughed. And so the question that has to be asked is how quickly do these workers re-engage in the economy and how quickly can they become re-employed again? Or do we actually see structural long-term unemployment as economies come back in an atrophied state? When we look to the other side of this, of course, we've seen fiscal and central banking policies really trying to support the economy while the governments have really suppressed all social and economic activity to try and retard coronavirus growth. We've seen some absolutely huge fiscal programs come out. We've seen momentous, very swift, aggressive central bank policies coming out too. And in this environment, of course, investors rightly fear monetary debasement. That's the devaluing of currency just by expanding its base. And also fears of inflation, possibly even deflation. And in these times of uncertainty, it's not surprising to see gold up quite significantly, certainly compared to other asset classes. So gold's trading up about 30% over the past 12 months as both a traditional safe haven and also as a hedge against inflation and monetary debasement. So let's have a little look inside some of the actions of the central banks. US Fed has now increased its central banking balance sheet from 4.5 trillion US dollars thereabouts in early March to about 6.5 trillion US dollars in the last update that we had. And to kind of give you an idea of what this increase in their balance sheet means that they've actually pumped money into the economy, which represents about 12.5% of US GDP. So these really aren't insignificant numbers in any shape or form. When we turn our attention to Europe, we see ECB, European Central Bank, also using open market operations and bond buying programs. Actually, we saw earlier in the week a rather harsh accusation of the German Constitutional Court come out saying that they believe that the EU court, which has supremacy, overstepped their powers, really green-lighting the ECB's 2015 bond buying program. ECB were very quick to come out with a news statement saying we're going to continue with doing whatever it takes to support the European economy and financial system. But it wasn't enough to actually stave off the euro tumbling. It hasn't recovered really since. We also saw Italian bonds fall as well. This both off that German Constitutional Court ruling, as well as there's some economic surveys and forecasts out saying that Italy, Spain and Greece could actually see about 9% of GDP shaved off in 2020. So if we turn now our attentions to why markets aren't completely tumbling in this environment, then we look to the positivity stories. And those positivity stories really, I think, is best shown through what's been happening with the price of oil. So oil, of course, if we went back to April 21st, we saw on the West Texas Intermediary WTI index a negative front month contract. That was essentially, nobody was actually willing to actually buy the May contract over fears of storage and really just demand fall off. We've now seen that recover to some extent. There's still also an awful lot of volatility in the markets, but we've seen WTI now trading at about $24 and Brent trading at about $29. So we've seen those up about 20%, 27% respectively over the past week or so, still down over the month. And this is really off the back of some of that Chinese data coming out this morning saying that exports were higher than thought, as well as the reopening stories of economies, as well as those production cuts that we've seen from all around the world. So let's have a little look at the reopening stories. Of course, we saw 4 million Italian workers return to work this week as Italy started to ease some of its lockdown measures on Monday. Germany came out with a statement yesterday just saying that they feel they're now in a position where they could actually reopen most areas of the economy, which is of course very, very positive. Britain, of course, we have seen stuff come out saying that potentially we could see some ease on their lockdowns from Monday. And when we look to the US, if we look to the map of the states, it's a very, very pleasing sign to see a lot more. And in fact, I'd almost say a majority of states now either in a state of partial reopening or expected to start that process very soon. And this has really rapidly changed even over the past week or so. So markets really taking a lot of positivity, rightly so, from these steps by governments to now start to put the economy back into life. I think probably where we see some volatility in markets could be just as investors realise that ending a lockdown is not an event, it is a process and it takes time. Certainly when we look to some of the data coming out of China, that we would be very wise to take heed of that. But there is an amount of positivity that I think should be taken from these steps as it allows the economies to at least start to rebuild themselves and a base for markets to really perform from. So as it's a bank holiday tomorrow here in the UK, I'd just like to say thank you very much for your time, and from all of us at 75.3, we wish you a very healthy and happy weekend, and we'll be back next week with the headlines.